Hey guys, well, the jacket's on, so this must be serious. Rightio, the government has handed down the 2026 federal budget, and I'm here to run down what is actually going on in the budget, just so you know the facts. I'm not going to get too political in this one, purely because there's obviously been plenty of commentary around that, so I won't get into that. I just want to get into the facts and what this means for you as a business owner or an investor. Right, so the first thing, capital gains tax. So how it's going to work? So any assets sold prior to 1 July 2027 will still be able to get the 50% discount. So we still have time on this, we've still got 12 months to get the 50% discount on that. So any assets sold post 1 July 2027, we have to apply an indexation is what they call it. So basically any existing assets up until 1 July 2027, we can still apply the 50% discount up until 30 June 2027, but then after that date, we apply indexation from there. So what's going to happen there? So at 30 June next year, you are going to have to get a valuation on all of your assets from there, and then at that point, we claim the 50% on that, and then indexation after that. So you won't be paying capital gains at 30 June next year. It's just we lock that in, that gain is locked in at 50%, and then indexation after that point. So this applies to all assets, not just property shares. It even includes pre-CGT assets. So if you own an asset that was prior to when the capital gains tax was brought in, they're now up for capital gains. But prior to 30 June 2027, you won't have to pay on any gain you made prior to that. It will only be any gain that you make from the valuation date of 1 July 2027 until you sell it. So any pre-CGT assets will now be taxed. However, new residential properties will still be able to get the 50% discount. So if you buy a new residential property in say 2 years' time, you can still use the 50% discount. It is the only asset class that remains with the 50% discount. So shares, managed funds aren't counted, existing properties don't count, only new residential properties get the 50% discount moving forward. So negative gearing. So what is negative gearing? Negative gearing is when you have a rental property and your interest and costs of that property are more than what the rent is. So in the past, we've been able to claim that loss, if you like, against your other income. But so moving forward, if you own an existing rental property already, prior to the 12th of May 2026, we can continue claiming that negatively geared property until you sell it. Whether you sell it in 2 years or 20 years, we can still claim negative gearing. But if you enter into a contract on a property after, basically from the time you're watching this video, we can negatively gear it up until the 1st of July 2027. But after that date, any losses that you incur on that property have to be quarantined against future profit or the capital gain when you sell the property. However, new residential properties and super funds can still claim negative gearing. So you can see there, buying property, the type of property and your structure are key when buying property here. So next up is trust. So in the 2029 financial year, so we've still got 2 years until this kicks in, 30% tax on trust. So effectively what they're trying to do here is, so if you have a trust with, we're using like a bucket company or distributing to individuals on lower tax rates, that's basically at the window now because they are going to charge a 30% tax on that distribution. So any beneficiaries on lower incomes, bucket companies, gone. 30% tax on those ones. However, there is a rollover relief if you want to transition to a company. So we do still have 2 years to do this. So if you're an existing client watching this, when we catch up over the next 12 months, we will review your situation to see whether rolling over to a company rather than a trust will be beneficial for you or not. So that is a huge one. So you can basically see here, things that they're attacking here are trusts and things that aren't new properties. So with trusts, no longer getting capital gains, well, indexation, which isn't probably potentially going to be much depending on the situation, no negative gearing for trusts, and 30% tax on trusts across the board. So you can see they're basically trying to wipe out trust completely, which changes the game when it comes to structuring your affairs. So if you're looking to buy a new business or a new investment, talk to us well before you do so that we can get this right, because if we get it wrong, it could cost you a lot of money in tax. So one other thing, so with companies, so this is probably the only win for business owners in the budget, is that companies can now use a carry back losses. So if you make a profit in 1 year and pay tax and then make a loss the next year, you can then claim some of that tax back for the loss you've made. So that is one win in amongst all of this. So other things that they have mentioned, fraud. They are giving the ATO $86 million to monitor fraudulent accountants. So thanks Jim Chalmers for that one of your best. Phone help. They are now giving $8 million for small business owners' mental health hotline. So if you're a small business owner and you're struggling to deal with this, you can call someone who cares.